Welcome to episode #69 of the Crynet GenShow. I'm your host, and this week, the institutional wall. It isn't just a metaphor anymore, it's officially crumbling.
It really is.
We're seeing a massive shift in global power dynamics. While Bitcoin is sort of playing this tug-of-war around the $90,000 mark, South Korea has just ended its 9-year ban on corporate crypto investments.
Which is huge, a sleeping giant, genuinely waking up.
At the same time, you've got the SEC reportedly dropping a dozen enforcement cases, signaling a kind of ceasefire in the regulatory war. But don't mistake that for no rules.
Oh, not at all.
The UK and EU have officially launched mandatory tax reporting, and Dubai is drawing a very hard line on privacy tokens. From the high-stakes meetings in St. Moritz to a massive, $840 million token unlock for Ondo, we have a lot to unpack.
It's a packed week.
The era of corporate crypto is here. Let's get into the top 10 stories of the week.
It is a massive week.
Yeah.
When you step back and look at the timeline, just between January 12th and the 19th, you realize we're not just reading headlines anymore. Yeah. We're watching the fundamental structure of the market change in real time.
It feels heavy, and I want to start with the story that I think a lot of people might have skimmed over because it sounds like, generic international news. But you're telling me it's actually the most significant thing that happened, South Korea.
By far.
So for 9 years, they've had this ban. If you were a company in South Korea, you could not hold crypto. Now, suddenly, the ban is lifted. Why is this such a big deal? Is it just because more people can buy Bitcoin?
It's not about people anymore. You have to understand the structure of the South Korean economy to get why this matters. The economy there is just dominated by the chaebols.
The chaebols, right. Those are the massive family-run conglomerates, right? Like Samsung, LG, Hyundai.
Exactly. I mean, these companies are the heartbeat of the nation's GDP. For the last decade, the South Korean crypto market has been driven almost entirely by retail traders. Regular people gambling on their phones.
That's where the kimchi premium comes from.
Precisely. That's why Bitcoin actually trades at a higher price in Seoul, because the retail demand is so ferocious.
Right. I've always heard about that. It's like a surcharge for pure enthusiasm.
It is. But while the public was buying, the chaebols, the companies with the actual, massive balance sheets, were legally handcuffed. They've been sitting on the sidelines with billions of dollars in treasury assets, watching this asset class perform, and they couldn't touch it.
So this law change isn't just letting a few tech startups open a wallet. We are talking about opening the floodgates for the biggest industrial titans in Asia.
And, maybe even more importantly, the pension funds. When you unlock pension funds, you're not talking about speculation anymore. You're talking about generational wealth preservation. By lifting this ban, the South Korean government is effectively validating crypto as an institutional-grade asset. They are projecting that we'll start seeing this capital flow into the market starting in Q1 2026.
That's basically now. It's interesting timing, though, isn't it? You have this Asian giant suddenly waking up and saying, game on, right at the same moment the United States seems to be putting down its guns.
The ceasefire.
Yeah, let's talk about this SEC news. We're hearing reports that under the new chairman, Paul Atkins, the SEC is dropping or dismissing something like 12 major enforcement cases. Is this for real, or is this just political theater?
The data suggests it is very real. And just look at who is being targeted. Binance, Coinbase, Kraken.
The pillars of the industry.
Exactly.
I have to play devil's advocate here. For years, the narrative has been the SEC is coming for everyone. Why stop now? Did they just get tired?
I think they realized the strategy just wasn't working.
The previous administration was operating on the strategy of regulation by litigation. So basically, they wouldn't tell you the rules, but they'd sue you if you broke them.
Which is an insane way to govern a market.
It's incredibly expensive and inefficient. It's like getting a speeding ticket on a road with no
speed limit signs.
Exactly. And what Atkins is doing is pivoting. He's moving toward creating a clear rule book. By dropping these cases, he's removing the existential risk for these companies. If you're Coinbase, you've spent the last few years hoarding cash for legal defense fees.
Right.
Now, you can take that cash and put it into R&D. You can build.
So the fear premium is evaporating in the U.S. just as the liquidity gates open up in Korea.
It's a powerful combination. It changes the psychology of the market from, survival mode to growth mode.
But here's what I don't get. If the news is so good Korea is buying, the U.S. stopped suing, why is Bitcoin so boring? It's just stuck in this range between $90,000 and $96,000. Shouldn't we be mooning? Boredom is actually very bullish right now.
Explain that to the day traders who are falling asleep at their desks.
Well, think about who owns the Bitcoin now. We have the ETFs. They currently hold about 7% of the total Bitcoin supply.
As percent.
Yep. That is roughly $140 billion locked up in institutional vehicles.
That's a huge chunk of the float.
It is, and this is what you'd call patient capital. Pension funds and RIAs, they don't panic sell because Bitcoin dropped 2% on a Tuesday. They rebalance quarterly or, annually. They act as a massive anchor.
So that's the floor.
Right. The reason we aren't crashing is that the floor is much higher and much harder than it used to be. But the reason we aren't mooning immediately is that institutions also sell into strength to rebalance. We're seeing the dampening effect of professional money.
So the days of 20% swings overnight might be behind us?
For Bitcoin, possibly. The volatility is being smoothed out by the sheer size of the participants now.
Okay, so the dumb money volatility is gone, replaced by this steady institutional hand. But money never just sits still. If the big banks and TradFi giants aren't fighting lawsuits anymore, where are they putting their energy?
They're going shopping.
Shopping for what?
Infrastructure.
Yeah.
There's this fascinating report predicting that crypto M&A mergers and acquisitions is going to hit a record $37 billion in 2026.
$37 billion? That is an insane number.
It is, but the logic is sound. It's the classic buy versus build dilemma. Imagine you are a massive traditional bank, a JP Morgan or HSBC. Your clients are screaming for on-chain access, tokenized assets, instant settlement.
Right.
Do you try to hire 500 blockchain engineers who are incredibly expensive and hard to find and spend 3 years building your own proprietary blockchain division from scratch?
Sure.
Or you just write a check.
You just write a check and buy a company that has already built it, debugged it, and has it up and running.
You buy the factory. You don't try to build the car from scratch. Precisely. You buy speed. We're going to see traditional finance buying up custody providers, the on-ramps, all the pipes of the crypto world. They aren't trying to beat crypto anymore. They're buying it to integrate it into their own systems.
You know, this lines up perfectly with a report I saw from Lloyd's Banking Group this week. They were talking about stablecoins, but not in the way we usually hear about them.
The B2B report.
Yeah. Usually when we talk about adoption, people imagine paying for a latte with Bitcoin or USDC. But Lloyd's is saying, no, that's not the main event. They're calling B2B stablecoin payments core to UK finance now.
And they're right. The whole retail latte narrative is a distraction. The real revolution is boring back-end settlement.
Break that down for us. Why does a bank care so much about stablecoins?
Efficiency.
Yep.
Pure efficiency. If you are a UK manufacturer and you need to pay a supplier in Singapore and you use the traditional SWIFT banking network, that money might take 3 days to arrive.
If you're lucky.
Right. It passes through correspondent banks, everyone takes a fee, and if you try to send it on a Friday afternoon, forget it. You wait until Monday. It's archaic.
It is.
Now compare that to a corporate stablecoin transaction. You send millions of dollars in USDC or euro-backed token. It settles in 6 seconds. It costs pennies. And it works at 3 a.m. on a Sunday.
So Lloyd's is basically saying the businesses are adopting this way faster than consumers because it saves them actual money and time.
Correct. It's pure utility. And that theme utility over hype was the exact sentiment coming out of Switzerland this week.
Ah, St. Moritz. The Davos of crypto.
Very fancy, very exclusive. 250 of the top investors and policymakers in the world.
Did you get an invite?
My invite must have been lost in the mail. But we have the notes. And the consensus from the mountains was very clear. The roadmap for 2026 is defined by 2 things, RWA and AI.
Real-world assets again. We keep hearing this phrase.
Because it's the logical conclusion of the stablecoin conversation we just had. Once you have the rails, the stablecoins, you need something to put on the train.
Yeah.
Bonds, real estate, private equity.
And the AI part, is that just buzz?
No, it's functional.
Well,
You have billions of tokenized assets moving around 24/7. Humans can't manage that.
yeah.
You need AI agents to manage the liquidity and the risk. That's the vision these guys are betting on.
It sounds like a utopia of efficiency. You have Korean pensions buying in, American regulators backing off, banks upgrading their plumbing. It sounds like we won. But
There is always a but.
there's a dark side to this institutional hug, isn't there? The more the suits move in, the more the privacy seems to be evaporating.
That is the trade-off. You cannot have global banking integration without global banking surveillance. And this week, that surveillance got a name. CARF.
CARF. It sounds friendly, like a scarf, but I have a feeling it's not.
It stands for the Crypto Asset Reporting Framework. As of mid-January, the UK and EU have fully launched it. It's essentially a transparency dragnet.
What does that mean for the average user?
It means if you're trading on any compliant exchange in Europe or the UK, your transaction data is automatically reported to tax authorities.
Automatically. So the days of, oops, I forgot to put that trade on my tax return are over.
Dead over. The system is now designed to see everything. And it's not just reporting. Look at Dubai.
Yeah, the Dubai Financial Services Authority. They take a hard line this week.
A very hard line. They explicitly banned privacy tokens within their financial center.
So tokens like Monero or Zcash.
Banned. Cannot be traded. The rationale is simple. To meet global anti-money laundering standards, they can't allow assets that obscure the transaction history. If the regulator can't see who sent the money isn't allowed.
This feels like a classic squeeze. Europe wants all your data. Dubai bans the tools that hide your data. You would think this would kill the market for privacy coins. If you can't use them in the major hubs, they should go to zero, right?
You would think so. But look at the charts.
It's the exact opposite. Monero surged 40% this week. It hit a new all-time high of $706.
Which is just fascinating, right? This is the privacy paradox.
Explain that. Why would the price go up when the government says no?
It's a vote against the system. The pump in Monero is a direct reaction to CIRF. As the mainstream system becomes a glass house where everyone can see in, a significant amount of capital is fleeing to the edges. They're realizing that if they want privacy, they can't stay in the white-listed corporate crypto world.
So the market is splitting in two.
It's bifurcating. You have the whitelist, economy compliant, regulated, slow, safe. And you have the gray market, private, volatile, decentralized. Monero hitting 706 tells us that the gray market isn't dying, it's just becoming a premium product. People are willing to pay more to be left alone.
That is such a wild dynamic. The corporate world gets the ETFs and the privacy world gets the rebellion. But speaking of market mechanics and maybe testing the conviction of that whitelist economy, we have to talk about what's happening literally today, January 19th.
The Ondo unlock.
Yeah. We saw a massive liquidity event for Ondo Finance. They released 1.9 billion tokens into the market that's valued at roughly $840 million.
That is a massive amount of supply to hit the market in a single day.
I feel like we hear about unlocks a lot, and sometimes people glaze over it. Can you explain why this actually matters to the price?
Think of it as a stress test. For the last year or so, early investors, the team, the VCs, they haven't been allowed to sell. Their tokens were locked. Today, the lock opens.
So suddenly you have $840 million worth of people who can sell if they want to.
Exactly. It's a supply shock. If the demand stays the same, but the supply suddenly jumps by 800 million, the price should theoretically drop. Unless the conviction is higher than the desire to cash out. How the price reacts to this unlock is the ultimate truth serum. If it crashes, it means the insiders were just waiting to exit. If it holds or even goes up, it means the big money believes in the 2026 roadmap we talked about earlier.
It's the difference between a cash grab and a long-term play.
Precisely. And in a month where we have about $5.5 billion in unlocks across the market, these stress tests are going to tell us if this bull market has real legs.
It's a lot to process. We have governments opening doors in Asia, closing loopholes in Europe. We have banks predicting billions in acquisitions, and privacy coins hitting all-time highs in protest.
It's a complex ecosystem, but the direction is clear. The walls between traditional finance and crypto finance, they aren't just lowering, they're being dismantled.
And as they crumble, we get to see what gets built in that place.
And it looks like what's being built is a highly regulated, highly efficient institutional machine with a very expensive private shadow growing right alongside it.
A perfect storm for a fascinating year ahead.
Indeed. 2026 is starting off with a bang.
And that wraps up a very corporate deep dive. If there's one thing to take away from the week of January 12th to the 19th, it's that the market is professionalizing at breakneck speed.
It really is.
Between the record $37 billion in M&A predictions and Lloyds Bank reporting the rise of B2B stablecoin payments, the pipes of the global financial system are being replaced by blockchain technology piece by piece.
And the volatility in Monero and the massive unlocks in Ondio remind us that the old crypto world is still very much alive, even as the new one takes its seat at the table.
You can find all the links, reports, and the full top 10 list in our show notes. If you enjoyed the show, don't forget to follow us and leave a review. It really helps the algorithm find more builders like you.
It does. Thank you.
Stay professional, stay decentralized, and I'll see you in the next one.